Well, it was a busy week for financial markets last week, although it appears that US-China trade relations are solved for the time being, while the FOMC delivered a more hawkish than expected 25 basis point cuts, even as the ECB and the BOJ stood pat. And of course, mega cap earnings largely delivered or beat expectations, besides perhaps Meta, although that wasn't enough to stop stocks from reaching new record highs and also propelling the dollar to its best levels since August. Looking ahead to this week, another 4 G10 central bank decisions are on the docket to look forward to as the US government shutdown drags into another month and we get ever closer to the end of 2025. Plenty, as always, for us to discuss on the trade-off this week. So without further ado, let's crack on with the show. So it was good news on the US-China trade relations front last week. Some might even view it as a miracle that the two came to a year-long deal. Something else that was a miracle was West Ham beating Newcastle 3-1 over the weekend, which is something that my co-host Ryan Littlestone from Forex Flow Live and Forex Analytics, I'm sure, is pleased as punch about this afternoon.
Yep, we're back. Our title challenge may have taken 9 games to get going, but we're on the road now.
Mate, the only title you're going to be challenging for is the championship one next year.
Oh, is that another little bet, is it?
Oh, no, well, actually, you'd be wise to take it because every bet you take, you seem to win. So,
yeah, well, let me have a think about that. I'll let you know after the Burnley game.
But anyway, it was, in all seriousness, a busy week for financial markets last week. We had US-China relations seemingly being solved, US-South Korea trade deal being agreed, the Fed delivering a 25 basis point cut, mega cap earnings. I mean, out of all that, what would you say was the most important of those events in a line?
I'll win on Sunday. But seriously speaking, I mean, it was a big eventful week. It's hard to try and pick out the choice things. I think the Fed was obviously a surprise, which you're going to talk about, and I'm still a bit sceptical over what happened between Trump and Xi. But again, we'll talk about that as well today.
Well, indeed. Victor Meldrew will cover trade relations momentarily. But first, I want to have a look at the Fed. So let's get on to topical thunder. There really is no pleasing some people, is there? His football team's won, China's solved, and he still finds something to be unhappy about. Anyway, we'll get onto that later on. First things first, the Fed, the FOMC delivering a 25 basis point cut last week, bang in line with expectations, lowering the target range for the Fed funds rate to between 3.75% and 4%, basically doing what we all knew they were going to do, and certainly what money markets had discounted in advance of the meeting. There were, though, in my mind, probably 3 surprises from the meeting itself. The first of those being that we had dissents on both sides of that 25 basis point cut. Governor Stephen Miron dissenting in favour of a larger 50 basis point move. No real surprise there. But more surprisingly was Kansas City Fed President Jeffrey Schmidt, who actually dissented in favour of holding rates steady. So clearly divisions on the FOMC growing, at least relative to where we were in September. Secondly, and probably in light of those divisions, we had what I would argue was a hawkish press conference from Fed Chair Jerome Powell, who noted that another rate cut in December is, and I quote here, far from being a foregone conclusion. And what was important about that remark was that Powell actually made it in his prepared statement, as opposed to being in response to a journalist's question, which suggests and adds greater weight to the idea that that was a deliberate policy signal and Powell seeking to build greater optionality into the future policy path. The third surprise, at least in my mind, given that I thought quantitative tightening would run until the end of the year, is that the Fed have actually announced they're going to end balance sheet runoff on the 1st of December. Although perhaps that isn't surprising, we do continue to see stresses in US money markets. And as a result of that, you look at the decision to end QT and actually say this is a proactive call from the Fed, who are continuing to take a risk management approach. Obviously, on the back of that, we've seen a hawkish cross-asset reaction. Treasury yields higher across the curve. Money markets repricing in a hawkish hawkish direction. We now see about a 2 in 3 chance of a rate cut in December, discounted by futures contracts. That was fully priced this time last week. But frankly, it makes sense in my mind why Chair Powell would want to build in extra optionality. We have 7 weeks until the next FOMC meeting. Potentially in that time period, we're going to get 3 labour market reports, 3 PCE numbers, and 2 CPI prints if the government can get itself reopened. I can see you shaking your head there. And it's no surprise that Powell wants to have a bit of optionality given what could happen between now and the 12th of December. But having said that, the overall direction of travel for policy remains very clear. The Fed funds rate is on its way back to neutral, somewhere about 3%. The balance sheet is bottoming out at neutral, 20-21% of GDP. And maybe more importantly than that is that those two policy levers are, for the first time in about 18 months, now going to be working in line with each other as opposed to pulling in opposite directions. And that, in my mind, frankly, whether the Fed cut in December or not, is a very, very powerful backdrop for risk sentiment.
Yeah, that and the fact that we may know by then, the December meeting, who's going to be replacing Powell as well. So that's going to add some extra spice. But the key thing for me since the FOMC is the fact that we've seen the depth of the split in terms of what people are voting for with policy. We had 2 non-voters, Logan and who's the other one? Hammack. Yeah, Hammack. Both saying that they wouldn't have voted for a cut at that meeting. So that suggests that if they were in the seat, it would have an even bigger split. So, yeah, people are saying, oh, well, it's a split central bank. They don't know what they're doing, all that sort of thing. But that's why you have these members voting. They've all got different opinions. They all in charge of different regions. It's healthy. They're not as much a clown show as the Bank of England and what happens with those guys. But, it just shows you at the moment that we have got a sort of 2-speed economy going, and there's people on both sides of the mandate who some are looking at inflation, some are looking at jobs, some are looking at whether tariffs are going to bring lasting inflation. Is the jobs market weakening, or is it just going through a little bit of softness? And they're all in the same boat. They don't know what the future holds, and to that end, Powell's got to walk the middle line, and as you say, keep that optionality in. Maybe he thought, after the September meeting, and way back then I said it was going to be the big one. It's going to guide the market for the next 3 to 6 months, and maybe he thought, well, perhaps everyone's too dovish over what's coming up, and we just need to address the balance or redress the balance a little bit and just steer things more towards the middle. But it was definitely a bit of a surprise meeting nonetheless.
Yeah, very much so. And I think you allude to an important point there, which is that Powell's language perhaps had to be more forceful than otherwise would have been the case in order to actually get the market to sit up and take notice. The fact that it was in the prepared remarks, the fact that he repeated it again during the Q&A, all of that was probably necessary to engineer the optionality that he needs. If he'd just stood up and gone, we're still data dependent, the market's going to go, well, okay, well, we're data dependent too, and we think you're going to cut in December anyway. Of course, the problem with data dependency is we're not getting any data. The government shutdown is now in its 2nd month. I think if we get to the end of this week, it's going to be the longest government shutdown ever. And given the fact that the Democrats and Republicans don't even have a basis on which to negotiate, let alone having started negotiations, it looks like that could carry on for some time. So why don't you take it away?
Yeah, it's something that I've been saying for a while. It's the length of the shutdown that's going to count, and when we're going to start to see maybe the economy taking a little bit of a hit from it. As this shutdown rolls on, we're now seeing more sort of pay packets and benefit programs, falling under its wheels, and we're about to see perhaps the start of the economic impact from all this. We've got this week's ISM data. I don't think it's likely to reflect any major shutdown problems in the broad economy, but I suspect we'll hear about halts to government programs and contracts impacting some firms. The last few months it's all been about tariffs, trade tariffs, but I think we're going to hear that shutdown comment popping up a lot more this month. Of course, there's going to be a lot of focus on the employment and prices data within these ISM reports and the S&P PMIs as well. Now, normally this week it would be an NFP week, so we'll have to once again rely on other data for our jobs fix. Last week, the ADP people decided to start a weekly jobs report release, which showed 14,250 jobs gained, I think, to 4 weeks to the 11th of October. We'll get another one of those on Tuesday. Oh, here we go. Here we go. Put your hand up.
He knows what I'm going to say.
I know what's coming.
I was going to say, are we going to have an ADP weekly sweepstake now? But I think you probably got that punchline before I said it.
I'm not doing a post weekly. It's enough doing it once a month, let alone whatever. But yeah, I mean, if the shutdown goes on, I might have to do a competition on the ADP number because that's all we're getting. But yeah, so we're getting another one of those on Tuesday. I don't know how that is going to impact the monthly number that we get on Wednesday. So that's one thing we'll have to have a look at. But I think one employment number that we're going to have to pay attention to is Thursday's change of layoffs. You know, there were some fairly big layoff announcements in during the recent earnings reports. You know, UPS 48,000 layoffs, Amazon 14,000 layoffs, among the biggest. So this week's report, I think, there's a risk that it could be a big one because there's a lot of firms that we don't know that might be laying off that might pop into that report. So I think it could be a bit of a big one. That's the risk anyway. Now, what's interesting about the October job scene is that it's usually when we start to see holiday hiring starting up. So if that picture looks bleak, that won't paint a good picture for the economy going forward because that suggests firms are not looking for a good seasonal consumption period. We've got Thanksgiving, we've got the Cyber Monday, Black Friday sales, Christmas. You've really got to take November and December sort of the retail picture together. But if there's no strong hiring into that holiday season, that's gonna, maybe send a little bit of a shock through the market. And obviously with Powell giving a bit of an undovish shock last week, if the data is bad this week, that dollar strength that we've seen since the FOMC and in the latter part of last week could well evaporate as quickly as it came in.
Yeah, excuse me, potentially. Sorry, I think. Yeah, we are going to have to rely on this private sector data. Actually, I wrote up a note on this this morning, and perhaps mercifully, the private sector data shows that nothing in the labour market has really changed since the last official jobs report, which would have been all the way back in August now. It's still very much a sort of no hire, no fire labour market. As you said, that 14,000 ADP print kind of symbolises that quite well. The issue now, though, and I mentioned this in your room earlier on, is that we're getting to the point where we've now had no data for the month of September because the agencies were closed and couldn't actually release the data. We went through the entirety of October with the government shutdown, so actually no data could be collected last month. If the shutdown runs beyond the end of next week, that's then a third non-farm payroll reference week that we'll have missed. So that you're then talking about November data being delayed. There's a real risk actually at this point that certain releases, the statistical agencies actually say we're just not going to produce the data. For example, the October CPI numbers, October retail sales, the October jobs report. There is a very, very real risk that the BLS just sort of turn around and say, that data is never going to be published. And as you said, I think those layoff announcements are worth watching very, very closely indeed, because the sort of working assumption I've had for the US labour market for a while now has been we've gone through or are going through this sort of 6-month long adjustment to the tariffs that were announced in April. That was a big shock. Labour market needs to adjust to that, and then we reaccelerate. And if you look at things like the NFIB hiring intentions metric, that does show that businesses are looking to hire again. And that should lead non-farm payrolls higher and overall employment growth higher. But if we are starting to see actually the opposite of that, and businesses beginning to lay staff off, then that is potentially a bigger structural issue that the labour market is going to have to deal with.
Yeah, exactly. And you think about firms who've got government contracts. We're into sort of month 2 now of when they're not getting any money coming in, not getting any work coming in. At some point, this no hiring and no firing, there's going to be costs that need to be cut. This is why I think, perhaps we're on the cusp, probably, not to see anything major happen at the moment, but we could just start to see the snowball starting to roll where some firms are saying, well, sorry, we've got to let you go because the government's shut, we're not getting any work in. And then that becomes a snowball effect. The longer it goes on, then it has a more of an impact on their suppliers and down the chain, and it all shifts down. And one of the other things I'm worried about is that I know a lot of people, well, I think yourself, saying, yes, this shutdown's not a big deal. Once it gets over, there'll be a recovery. I'm worried about how weak that recovery might be, considering the jobs market is in a soft place already, let alone the rest of the economy. So it's still on the clock. It's the old how long is a piece of string? But if we get to December and we're still shut down, then I think we're really going to see the effects coming through.
Well, that's all nice and cheerful. And personally speaking, I hope the shutdown is resolved long before that, because I've got a lunch riding on it somewhere. So if Chuck Schumer or anyone is listening, please get this sorted by Thanksgiving, just to help my wallet out. Anyway, moving on from that, we hear from the Bank of England this week. Wonderful news. I'm sure everyone is on tenterhooks waiting for the MPC announcement on Thursday. Bank rate is set to remain unchanged at 4%. I think, frankly, it would be a bit of a stretch to imagine the MPC delivering a rate cut when they vote precisely 3 weeks before the budget. And of course, we really don't have any idea where the tax hikes are going to fall in terms of filling that fiscal black hole. And we certainly don't know the macroeconomic impact that those tax hikes are going to have. Having said that, once again, it's very, very, very unlikely that the MPC vote unanimously in favour of holding rates steady. You would expect at least a couple of dovish dissents, probably from Dingra and Taylor, voting for a 25 basis point cut. There's some speculation that one or both of those may look to vote for a larger 50 basis point move, given the slack that we're seeing open up in the labour market. You might also see one of the other members join that dovish camp. Potentially Deputy Governor Dave Ramsden is a contender for that front. But I think the majority of the committee will prefer holding rates steady for the time being. But that will be framed very much as a skip in the easing cycle, as opposed to the easing cycle being at an end. I think the policy statement will again retain the gradual and careful guidance that the bank have been using for quite some time now. Of course, I think the BOE are in a better place coming into this meeting than they have been the last couple of meetings. Inflation is starting to not necessarily move in the right direction, but at least settle down a little bit. Of course, headline prices rose 3.8% in September, which was below the bank's 4% expectation. We did see some signs of disinflation in the core services and food metrics as well, which may provide policymakers with some degree of comfort, but we're still dealing with CPI that's almost double the 2% target. So I think it is quite a tough ask to justify a rate cut this time around. We do get another round of forecasts from the bank this week, although there is a lot of doubt over where those forecasts are going to come and what they're going to look like. Ryan sent me an article earlier that some of the initial recommendations from the Bernanke review are going to be implemented in the monetary policy report this week, which means that the monetary policy report will be shorter and that the forecasts will be in a separate document. Why put the forecasts in the report? That's just how it is. There will also be an opportunity for each of the policymakers to explain their vote in detail, which I'm sure everyone is very, very excited about. They can already do that in the minutes. Quite why we're reinventing the wheel here, I don't know. But what I do know is that the last thing cable needs, or the quid needs at the moment, given that we're sat very, very close to our lowest level since April, around the 131 figure, the last thing that the pound needs right now is a dovish surprise from the BOE, whether that be a tweak to the guidance that opens the door to a December cut, or whether that be another couple of dissenters joining that dovish camp. But is it going to be a super Thursday, or is it going to be another shambolic Thursday on Threadneedle Street?
Oh, well, thank you for trying to jinx my pound short trade that I've been running since July. Comment,
sorry, mate, I didn't know about that one.
That's all right. That's all right. I'll keep it under my hat next time. But I think there's a bigger risk that we see a more close split in the voting. I think we could be seeing a 5-4 because that will set up. That will set up the following month. That will set up December just for to keep people on edge. You're right. You don't know what they're going to get from the budget, and they can't comment on the budget, obviously, and they're not going to do monetary policy specifically on the budget, but they will be worried about it, interested in what is actually coming, how it's going to affect the economy. It's okay saying, well, inflation is going to start coming down and it's getting lower, or it's stopped going up anything. But it's not going to matter if everyone's taxes go up and everyone's skint and can't afford anything. Then you're going to see inflation coming down at a hefty rate as everyone cuts costs to try and drum up some business. And then they'll be faced to chase inflation lower. So, yeah, I think they're going to try, or probably try and do a poor impression of power and try and keep optionality in the game and try and spin it however they can. But, with these guys, the votes could be bonkers. We could have 2 people voting for a 50 cut or something silly like that. So I wouldn't be surprised. It's all up in the air as always. It's all to play for. But I think, perhaps a tighter vote than what the market's expecting.
Yeah, there's also another factor in this that complicates things, which is the actual way in which the Bank of England vote, which is that the governor who chairs the meeting will say, I'm simplifying this, but will say, then up to policymakers to vote in favour of that action or against it and suggest what they would rather do. There's a case that says if Governor Bailey sits there and goes, I propose rates remain unchanged, someone like Alan Taylor goes, I'm going to dissent for 50 just to prove a point. And that's where you end up with things like we had in August, where you actually had to run the vote twice in order to get a decisive margin in favour of a certain policy action. And again, it could easily come down to Governor Bailey and his sort of casting vote if necessary. Last thing on the BOE, my view is December's unlikely unless we see really material labour market weakness, purely because they don't have a forecast round, they don't have a press conference, they can't explain that decision. And also it's a week before Christmas. Do they really want to rock the boat too much? Do you think that the market pricing a 70% chance of a December cut is reasonable?
Yeah, I think it is, because we're in the same position as the Fed. They want rates lower. They don't want rates up where they are now. It's just whether the economy is going to give them the leeway to do that. So, the path of rates is still down. I think that pricing is about right. I don't think they'll hesitate in cutting in December if they get the right numbers for it. But we know with inflation, it's very, very slow moving in the UK. We're not going to see it dropping off a cliff unless a certain someone has decided to torpedo the economy with all their tax hikes.
Which she's going to do. Let's be honest. Yeah. It's going to happen. Oh, no. Right. Before we depress ourselves, let's move on to something happier. US-China trade talks. Is it all a case of he said, she said?
Oh, God. Let me. Yes, he said, she said. Straight red for that one, mate. Absolute straight red. Disgraceful. Disgraceful things.
I've been storing that up for a week.
Someone said it the other week. I actually found that. I do actually find that. I like that one. Yeah, I did like that one. But you've had that in your back pocket for a while.
I have. I really have. Anyway, on to more serious matters.
Yeah, back to the subject in hand. I know it's one of your favourite subjects as well. Everything's all fine and dandy for now, but how long will that last is what I'm worried about. We've had China rare earth export controls paused for a year, US port fees suspended for a year, China's buying soybeans again supposedly, but they're only taking their quota up to what they were and should have been buying before anyway, so we're not seeing anything extra there. The chips and semiconductors are going to be flying again as well. Everything seems tickety-boo, but how long before it all blows up again? We've got China and Russia still the best of buddies, and there's still a negative element, underlying element to any deals that Trump has with China because of that Putin-Xi relationship. It's almost like they both take it in turns to talk nicely to Trump one minute and then fail to make progress on those talks and agreements the next minute. So, I was quite sceptical about the real value of any deals that Trump and Xi might strike last week. And what came out last week was more a case of returning to the status quo than breaking any new ground, getting any really new deals done. So, yes, US soybean farmers may be breathing a sigh of relief, but for everyone else, I think it's just a stay of execution until they have the next fallout. So I will remain sceptical about what was agreed, and I'll count the days up until the next bust up. Last week I was looking at Dolaar, and he had a little foray down to that 708, 709 area. Has been mentioning about that strength in the one that we've been seeing. It has recovered back to sort of the 710, 712 zone. I think it's likely we see a bit more sideways action there and perhaps some tightly controlled ranges, and basically until the next bum fight kicks off.
Yeah, I guess there's probably two aspects to this, really. I think the first is the initial market reaction, which makes complete sense, which is essentially binary on, is there a deal, is there not a deal? Is there a risk of an escalation, is there not a risk of an escalation? And right now, famous last words, knock on wood, there doesn't seem to be a huge risk of escalation. The threat of 100% additional tariffs has gone away. China have postponed their rare earth export controls for a year, et cetera, et cetera, et cetera. That makes sense. Markets price the escalation risk out. Risk rallies on the back of it. We all know that. We all saw that last week. The question, and this is not something that's going to come up right now, it's something that you need to sort of pay close attention to over the next 3, 6, 9, maybe even 12 months. They said it's a year-long deal, is compliance with the arrangement. Does China stick to its word and or place orders for the amount of soybeans that it said it's going to place? Does China keep rare earths flowing? Does the US stick to its side of the bargain and actually keep the fentanyl tariff at 10%, not 20%, and not threaten further measures and not do investigations into various sectors under 232 or 301 or whatever parts of commerce law you want to choose? That is now going to be the key focus, because we've almost gone max tension between the two sides in April and May. Then we had the truce. Then things slowly built up again, with the bears being poked on either side, port fees, Nvidia, Qualcomm, blah, blah, blah. Now we come back down to that low and those trade tensions. And as you say, everything sort of seems fine and dandy. The question is, as you rightly put it, is how long do things stay like this? Really, that is anyone's guess, given the volatility of the relationship between the two. It's like an old married couple. It's a bit like us two at times. But fundamentally, I think the message for markets at the time being is trade risks were right at the front of your mind, and everyone was hedging downside on the potential that we see an effective trade embargo between the two. Now trade risks are right at the back of our minds, and there doesn't seem to be a downside risk that we need to hedge right now. The trading opportunity comes, or maybe the risk management opportunity comes, as and when there are signs that tensions are starting to simmer away a little bit too aggressively once again.
Yeah, it's almost as if China turns up at these meetings and go, right, what's the least we can get away with? Oh, the least we can get away with is doing what we said we were going to do before. And then Mr. Trump goes running away saying, yeah, greatest deal ever. So, yeah, they didn't adhere to half the stuff they did in Trump 1.0. So like you say, are they going to do that in Trump 2.0? And I don't think, Trump wants everyone to stop buying Russian oil. Well, you've got two hopes of stopping the Chinese stopping buying Russian oil. And that's not a fight he's going to pick either. So there is still these underlying currents that go on between Russia, China, US, Russia, the three of them. And I think that's having more of an effect on these trade deals, because does China really need all of these trade deals? Do they need to go gangbusters and get greatest deals ever? Because, as they showed with soybeans, they're happy to go and purchase elsewhere.
Yeah, absolutely. And as you rightly say, we had that phase one trade deal all the way back in 2019, 2020, which seemed to take forever to get over the line. When it did get over the line, it wasn't really worth the paper that it's written on. So you could very easily and understandably make the case for that being the same thing this time around. I just think if you're trying to, fade any of the positivity on the back of the headlines we saw last week by going, it's not worth the paper it's written on, you're reading the situation wrong in terms of what the market wants to see in the here and now. But anyway, we will, I'm sure, revisit that one in the weeks and months ahead. For the time being, we need to move on to our plays of the day. So I'm going to look at we're both looking at the dollar this week. I'm going to look at the dollar index just because it annoys Ryan more than anything else. It did gain ground for the second straight week last week on the back of that hawkish Fed repricing that we have seen. And actually the greenback starting the new trading week on the front foot as well, being helped actually by a huge slate of corporate bond issuance, which is pushing treasury yields even further higher. Given that the dollar index has now broken to the top of the range that have been in place since all the way back in June, around 99.25, you'd be looking towards the 100 figure as the next obvious resistance to the upside, particularly as this hawkish repricing rolls on and the market seems to want to get back into a mindset of US exceptionalism and outperformance once again. But above the 100 mark, the real big level is the 200-day moving average, which comes in at 100.40, spot 45, probably 40 by the time we get there. Spot has not traded above that level since March. And of course, one of the things that even someone like myself pays very, very close attention to is those longer run moving averages, as they are a very, very good indication of when the trend is beginning to turn. And if we do get a close north of that, then you would say the trend is very much turning back in favor of the greenback. And just for those of you who hate the dollar index as much as Ryan, I've done a little bit of back of the envelope maths. And if we do get to about 100.45 on the dollar index, that would put cable at about 129, the euro at about 114.50, and dollar yen just north of 155. So some very, very big levels to keep an eye on across the G10 space. And speaking of 155, I have a feeling Ryan's going to speak even more about that right now.
Yeah, absolutely. Dollar yen's my play of the day this week. I'm hoping to do a bit better with this one this week after last week's dip buy idea that missed my order by 13 pips before rallying a nice sort of 160 pips after that. So, yeah, maybe I'm going to get in this one. But this week I'm going to be combining the techs and the fundamentals, my fundamental view that we might have perhaps seen the market running a little too far to the undovish side after the Fed. The 155 level is one of my big old historical levels that goes all the way back to the 1980s. So I expect to see some action if we get up around there. So it may be a bit of a stretch point naturally for this rally. If we do see some softer data this week, that could all combine to put in maybe some sort of decent top in play. So I'm considering a small short, maybe at market, maybe play up against the recent highs, 154.45, and add in if we get up to that 155 level. But I won't be slow to bail this one if we do break 155 pretty easily, though.
Indeed, pivotal level there. The other thing, of course, that we haven't really had time to discuss because there's so much going on is the BOJ, who didn't exactly close the door on a December hike, but they didn't exactly push it open last week either, which hasn't helped the yen particularly much. Anyway, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, bringing things together as brilliantly as always. And thank you very much indeed for watching. Hopefully you've enjoyed the show. If you have, do drop a like on the video. Leave a comment as well. Let us know how you're trading the markets or anything you'd like us to discuss next week. And that is when we'll be back with another episode of The Trade-Off. In the meantime, have a very good week ahead. Enjoy the fun of the fair at the Bank of England on Thursday, and we'll speak to you in a week's time. Thanks as always, and goodbye for now.